Welcome back. The Bank of Canada, in just over 24 hours from now, will announce a rate announcement. That's coming at tomorrow at 9:45 a.m. Eastern Time. Joining us to talk about it now from New York is Veronica Clark. She's an economist at Citi. Veronica, thanks a lot for joining us. Many of your peers in the economics community changed their view, their prediction of what the Bank of Canada will do tomorrow on Friday, when new gross domestic product numbers were released here in Canada, which ran stronger than expected. What is your forecast for tomorrow?
Yeah, I was also one of those changing my call. I was thinking that maybe the Bank of Canada would be cutting at this meeting, but we had stronger GDP data, some mixed details, but I think there has been enough mixed data and not a lot of forward guidance from the Bank of Canada that it's probably likely that they keep rates right where they are. We're at the midpoint of that neutral range right now, so they don't necessarily need to change rates at this meeting.
You do, as do some of your peers, expect further cuts in 2025. You expect a July cut, and do I understand correctly that you think that if a cut is announced in July, it could be a larger than typical cut? It could be a 50 basis point cut?
Yeah, I do think that's a really distinct possibility. It's been a lot harder than usual, I think, for me at least, and probably other economists, to really get a grasp on the Bank of Canada's reaction function lately. They're very explicitly not being forward-looking in their policy making. That's not usually how they operate, right? It's based on forecasts and how they see the outlook for inflation evolving. I do think even tomorrow they'll have more confidence that the upside risks to inflation are a lot less than they have been in the last couple months. But it's really the forward-looking data, things like home prices, expectations for the labor market to weaken more, an expectation that Q2 growth will be pretty soft and inflation will continue to slow, that I think they will be cutting. I think this is an economy that's going to need not neutral policy rates, but maybe slightly accommodative policy rates this year. And that could mean that we're getting a 50 in July.
One of the interpretations of that, those GDP numbers that were released on Friday, was that they were largely driven, or at least in part driven, by U.S. companies buying Canadian products ahead of schedule because they want to avoid tariffs. Do you take that view? And if so, what's that say about the midterm future of Canadian economic growth?
Yeah, absolutely. There was a lot of strength in those exports early in Q1. We've seen that come off somewhat, and we'll get April trade data this week, and maybe we get a further drop in exports to the U.S. But it is a lot of this front-loading activity ahead of those tariffs. That does naturally mean a pullback in exports later. Now, luckily, Canada has avoided some of these larger tariffs that the U.S. has put on the rest of the world. But things like softening U.S. demand, that's going to weigh on Canadian exports. Obviously, we do have substantial tariffs that are in place. Maybe the steel and aluminum tariffs rising tomorrow to 50%. So there definitely are those headwinds from tariffs and the lack of front-loading activity in Q2.
The Bank of Canada has been pretty blunt, cautioning Canadians that it can't both support economic growth and put a damper on inflation at the same time. It said its policy tools are not suited to deal with the effects of a trade war if those effects are slowing economic growth and rising inflation brought about by tariffs. Is that balance, at least temporarily, becoming a bit easier for the Bank of Canada to find?
Yeah, I think it is. The bank's been very cautious in their outlook for inflation, but I do think there's reasons to believe that the upside risks are a lot less than they were a couple months ago, even when they met in April. One reason being that some of the retaliatory tariffs that Canada has put on imports from the U.S. Those have been paused and delayed, so maybe that upside risk to inflation is a bit less. Also, we have seen some pretty dramatic weakness in home prices, wage growth that's slowing. There's reasons to think that demand would mean softer inflation this year. Maybe you do get into some upside risks from supply chain disruptions and tariffs into next year. But I think the appropriate policy is going to be reacting to the data that we have, and it does look like inflation, I think, should be softer this year.
What do you expect the messaging to be from Tiff Macklem and his colleagues at the Bank of Canada tomorrow?
Yeah, I imagine they're going to stick to this lack of explicit guidance that we've had the last couple meetings. You're not giving any, guidance explicitly on the path of policy rates in the statement. Maybe we'll learn a bit more about, how they're seeing the balance of risk. We, in April, they were supposed to have a forecast update, but they did this scenario analysis instead. I would wonder if they're going to update their forecast again in July. I imagine their baseline outlook is going to be for softer growth, softer inflation. That maybe could be a bit of a hint that maybe we're going to be more forward-looking in decision-making again. But I overall think it's maybe erring on the dovish side, but no real guidance yet.
Before we let you go, can we get your view on the Canadian dollar? Yesterday, it broke through 73 cents US.
Yeah, I mean there are a lot of reasons that we could see a stronger Canadian dollar. I think the issue is it's not so much Canada, it's really the US dollar, right? And there are a lot of ways that we've seen this US selling, this maybe lack of US exceptionalism story again. We do expect that the Fed could be cutting sooner. Maybe that would mean more weakness for the US dollar.
And that's the story on the Canadian dollar, is it? The main dynamic on the Canadian currency is expected weakness on the US currency?
Yeah. I mean, I think that's been the dynamic pretty broadly. This is a softer dollar environment.
Veronica, thank you so much as always. Veronica Clark is an economist at Citi, and she joined us from New York.